Jimmy, for joining us today. So to Kelly's point about this whole idea of active versus passive, your firm has really grown its credit assets as well as illiquid assets such as real estate over the last few years, now representing about 2/3 of your total AUM. How is that a reflection of this whole competitive dynamic with regard to active versus passive? I know credit's a lot more difficult to replicate in a passive instrument than, say, equities.
I think there's a few things going on at once there, but to start, the growth of passive investing is a good thing for the world. If an investor wants to earn the ups and downs of the S&P 500, it's a much better thing to be able to do so with low fees and low taxes. Amidst what we do, particularly on the credit side, that's really hard to replicate, as you say. So within the world of opportunistic credit, there's not an ETF that can work a company through a bankruptcy process or work a company through a liquidation of assets. So within credit, we try to focus on things where what we do, hopefully, we'll be able to have an edge in for a long time.
Where do you see opportunity in credit right now?
Right. Well, it's certainly not in generic credit, which I would call it. So yields are very low, spreads are about average, rates are obviously historically low. And so when we look in credit, we're not finding a lot of classically cheap bonds. It's just not the part of the cycle for that. Where we're finding opportunity is in what we would call idiosyncratic or special situations. So restructurings, litigations, liquidations, things like that, where the opportunity is not really driven by the market, it's driven by a specific event.
Now, you mentioned idiosyncratic risk. The remaining 1/3 of your business is in multi-strategy, of which a large portion of that is still in equities. I took a look at your 13F and saw some pretty big names in there. You've got Microsoft, you've got Amazon, MasterCard, Facebook. I know those are outdated names, but still large cap nonetheless. How do you find, especially in this market today, idiosyncratic opportunities in equities as a hedge fund to really help drive alpha?
So I'd zoom out a little bit. Within multi-strat, what we're generally trying to do, and we have 100+ investment professionals operating on 3 continents, focused on 5 big asset classes, is to look across all of that and see if we can find a handful of the best idiosyncratic ideas that are out there. And sometimes they are in big equities. There's nothing wrong with making an investment in a large cap equity name if we think it's going to perform well. But I'd say what tends to be more differentiated across the master fund are the ideas we're finding within the merger arbitrage space or within the corporate credit or structured credit space.
Let's talk about some of the recent market activity. Over the last few weeks in September, we've seen some interesting movements, especially with regard to factors, which for our audience members who may not know what those are, they essentially track things like momentum and value. And we've seen some pretty wild moves in those areas in the last few days. Can you help explain to us what exactly is going on there?
Sure. So, well, for starters, there's a lot more factor-driven capital today in the market than there used to be. And so what that means, for the passive investing comment you made earlier, investors can actually invest in a fund targeting a specific factor. And the more capital that gets raised in that space, the more exacerbated these factor moves can become. So what's happened this month is a big reversal in the momentum factor. It's really just an unwind of what happened in the momentum factor the month before, but what it really means is stocks that had been going up a lot and outperforming the market suddenly became the stocks that were underperforming the market. And so as we had this big rate rally over the last several months, a lot of stable yield type of names, things in the utility space or in consumer staples, were really outperforming. Secular growth was outperforming, which are some of the big tech names. And then that kind of suddenly unwound itself. And I think the trigger for that was likely this reversal in the 10-year that we've had this month. That kind of got it going. And because of how much capital is set up to chase these factor moves, it really stretches things out to an extreme.
It'll be interesting to see what that does to September performance. Jimmy Levin, the CIO of Sculptor, formerly known as Oxif, thank you so much for joining us.